Okay, so the next thing we are going to talk about after knowing the definitions is to look at how to deal with the figures. And therefore, we are going to talk about translation. And here, what we mean by translation is that we are trying to deal with conversion and transactions at different dates, all right, and how you are going to tackle the effect of the exchange rate. Now, we want to talk about the initial measurement. Or initial transactions. Now, if you transact at a particular point in time, you have to translate at the historical or spot rate. Okay, you have to translate at historical or spot rate. What do we mean by this? If you say you purchase a motor vehicle at say $5,000, when exchange rates at this time, or let's say on 01/01/2022, when the exchange rate at 01/01/2022 was say $1 is to 6 Ghana cedis, and you have another rate of March 2022 also being $1 is to 8 cedis. The initial measurement is saying that you will have to record the transaction. So this one, if your presentation currency is in cedis, and it means that this asset that you bought, you cannot record it in dollar in your presentation or your financial statement. You need to record the dollar at an exchange rate so that it will convert the dollar to cedi. Most of you who use accounting softwares in your offices can testify to this. Your software will ask you for exchange rate. You have to get a source with where you get your exchange rate from, then you put it there, because you actually spool your financial statement in cedis. All right, there are times where companies, those of you who work in some multinationals and even Ghanaian companies, you have to prepare bank reconciliation statement for your accounts that are in dollar. And remember, since your functional or your presentation currency may be in cedis, you will have to prepare this bank reconciliation in cedis. So there will be differences. Okay, that is what we are trying to discuss tonight. So what the initial measurement is saying is that if you have a transaction at that point, initially, you are going to translate using the historical or the spot rate. So herein, this is how you are going to record your transaction. So you do $5,000, and if $1 is equal to 6, how much $5 will be? Will be $5,000 multiplied by 6 Ghana cedis. And therefore, this one will give you 30,000 Ghana cedis. So it is this that will show up in your financial statement. Okay, so you have to convert the dollar into cedis at the prevailing exchange rate or historical or the spot rate. All right. So that is that. We've had issues about these things. Personally, I've had so many experiences about these things. The question has always been, where do you get your source? IAS 21 says that you have to stick to the source throughout. Okay, so if you are picking your historical, you have to stick to the source. Or it also says that you can also use the average rate. All right, the average rate, I've talked about it, okay, and you have to weight your spots within the accounting year. You will use the average rate if the condition is that if it does not fluctuate significantly, if exchange rate does not fluctuate significantly during the accounting year. I mean, if that is the case, then Ghana case, no company can ever use the average, especially in this year. I have used the accounting rate before, the average rate before in 2018. Yeah, it was quite stable, but it always starts hitching up somewhere June, July, because at that point, all the telecommunication companies have declared their dividends to their shareholders, and they will be sending money out. So they will need more dollar, and there will be high demand on the dollar, which always push the exchange rate higher. So that is how it starts. So it always starts from June, July, and if you don't take it, it's continuous throughout the year. All right, so that is that. But the key here is that you need to convert it at the historical rate. All right, so that is that. Okay. Okay, so assuming this transaction was done on credit, such that payment will be made later, then you have to record this transaction debiting your motor vehicle because you purchased it. So you see that it will be 30,000. Then you will credit your cash or credit payable. Since we are talking about credit here, you credit your payable of 30,000. Now, I want you to put this thing in mind because we are going to build on it, all right? And it's from the fact that it is a credit purchase. Now, let's build on it by coming to settled transactions. Watch this. This transaction happened on 1st January 2022, all right? Now, let's say that you make payments, okay? You have to now make payments. Now, if the transaction is settled within the accounting year, herein, what we are talking about is payment or receipt of. So if it is a receivable, it will be a receipt. Like this one that we've done is a payable. So we are going to look at it. All right. So this one, what is going to happen is that if we are going to pay, we will have to pay and translate the payment at the historical rate at the date of payment. At the date of payment. That is what is going to happen. Now, definitely, if we go by this, there will actually be some difference between the earlier transaction, this one, and the payment because of exchange rate movement, okay? And any difference will now be posted into our statement of profit or loss, okay? So this is what I'm saying. Okay, so let me add here with any exchange difference going to the statement of profit or loss. Now, watch this. If we bought this and let's say we are making payment for this transaction on, let's say, 31st July 2022, when the exchange rate is now, let's use Ghana situation. It's like $1 being equal to, around June, we had it around, I think 8. So let me use 8.50. Okay, so $1 is equal to 8.50 Ghana cedis. Now, if we are going to make the payment, then you realize that this same transaction, we will have to convert the $5,000 that we owe at this exchange rate. So what is going to happen is that if $1 is equal to 8.50, then how much will $5,000 be? It will be more, all right? Now you go through your if more or less divide concept, okay? So if you don't want to get confused around this, you can just do $1 is equal to 8.50. How much will 5,000 be? You don't know, and therefore you do cross multiplication. You have x is equal to 8.50 times 5,000. All right, so that is how you do it. Now, take your calculators. So it means that the $5,000 will be multiplied by 8.5 Ghana cedis. If you point it, I have 5,000 multiplied by 8.5. It's giving me 42,500 Ghana cedis. Now, what is going to happen here is that since I am making the payment, I will debit my payable, all right, with, you see, the amount that I owe is actually 30,000. That is what is happening. But what I am paying is 42,000. You cannot pay more than you owe, all right? So what is going to happen is that you will pay what? 30,000. But the cash that is actually leaving you is actually, the cash that is actually leaving you is 42,500. You realize that there is a difference between this one and the 30,000. And that is what we are talking about. There's a difference of 12,500. And that is where we say you would debit again your P&L, all right? And you call this one what? Exchange loss. And this is what is happening to companies right now in Ghana, exchange loss, so that your journal will balance. Remember, you cannot pay more than you owe, okay? So you are paying exactly what you owe, which is 30,000 at the date. You pay the difference here, and this is the key, is your exchange loss. All right, this is what is happening to so many companies in Ghana, because At the time that they bought on credit, they brought it to Ghana, the exchange rate was at 1 point. All right. When they now brought the thing to Ghana and sold the thing in Ghana cedis, because that is the currency that determines the sales price here in Ghana, the primary condition. Now, when they now sold those things in cedis, they now have to convert it into dollar so that they can now go and pay. All right. Now imagine if you sold at this point when the exchange rate was 6 and you gave it on credit, the people are paying in 15, 30, 60 days sometimes. By the time they pay you the money, exchange rate has gone up and it's now 8, meaning that you are going to incur the same situation we are talking about, exchange loss. And the funny thing is that our tax laws doesn't allow you to clear all these exchange losses against your profit. No, it has a limit to it. So that is the problem. All right. So this is a typical example of what we are doing, but we are only able to determine what this exchange loss is because it is settled within the year. Okay, settled transaction within the year. Because if you check here, it's 2022, but we bought it in 2020. All right, so that is that. That is that. I want to put up an illustration here. I'll share this manual with you. Okay, so it has all these things that we've spoken about earlier. All right. So it settles it. When you take your time and you read it, you understand. All right, so let's look at this illustration 3. I want to use that to explain it further. Okay, so let's look at this. On April 2018, Kweku Ama Company, a company that uses cedis as its functional currency, buys goods from an overseas supplier who uses comets as its functional currency. The goods are priced at this and payment is made in 2 months' time, later in May. All right. So we are asked to record the journal of this entry. Now, initially, remember, initial measurement is at spot rate. All right. So the date that the transaction was done. So we have 1st April here. And the transaction is how much? 54,000 that we have here. So you will see that you will have to convert this 54,000 because our functional currency is cedis. We need to convert the 54,000 comets into cedis. Now, this is the exchange rate as at the time the transaction was done. That is the exchange rate. So what is going to happen is that we need to convert this into cedis. Now, for what we have here, they are telling us that 1.80 comets is equal to 1 Ghana cedi. So how will we do our conversion? If 1.8 is equal to 1 Ghana cedis, how much will 54,000 be? Like I said, if you get confused, just do if 1.8 is equal to 1 cedi, then you have 54,000, which will be equal to what? X. So what is going to happen here is that you are going to do 54,000 divided by 1.8. All right, so that is what is going to happen. So you have 54,000. If you divide it by 1.8, how much are you getting? I am getting 30,000 here. So on April 2018, this gives us 30,000 Ghana cedis. All right, our journal on this date is actually going to be, we are debiting whatever we bought, our inventory, right? We bought goods, inventory, or you can say purchases, right? With how much? 30,000 Ghana cedis. All right, and you are going to credit your payable because you are actually going to pay the money in 2 months' time. All right, so this is it. Now, in 2 months' time, which is 31st May 2018, if you are paying, remember you have this money that you owe, but the exchange rate has changed now. Okay, so what is going to happen here is that you need to go through this same process. So you have the 54 that you are now paying, but the exchange rate has reduced and you have what? 1.75. Okay, so if you are going to go through the same process and do that, how much are you having? I am getting 3857.14. So let's say, let's round it and keep it here. All right. Okay, so that is that. But like I said, if you are now making the payment, the double entry is to debit your payable. Okay, we are paying it, and we cannot pay more than this 30,000 because this is the one that is seated here in our books. So we will debit payable 30,000 so that it will cancel this one off. Now our money is going out, that is our cash. All right, so what is actually going out is this money. That is our cash going out. So we are crediting it with 30,857. All right, you see that this bit is not balancing yet. All right, the difference here is that you have actually paid more than you bought. So there is another debit, which we call exchange loss. All right, if it is a credit, it's an exchange gain. So there's another debit, which is exchange loss, which is 857. All right, so that this plus this will balance off with it. So this one will go to your SOFP. This one too is in your SOFP. And this will be seated in your P&L. All right, so that is all how this concept works. I think it is so easy that you can actually take your time and go through it. All right, but let's look at situations where instead of the payment being made here, it is actually stepped into a new year, let's say 2019. What are you going to do? Okay, what are you going to do? So we are going to go through and discuss unsettled transactions. How are you going to do it? I have had much experiences about these things where you are closing your accounts, you will have to revalue, your creditors and your receivables because of exchange rates. So let's look at how that bit works. Okay, so let's go to unsettled transactions. Now, if a debt or something is seated in the books that is not settled, how are we going to look at it? Now, if a transaction is still unsettled at the reporting date, then it means that there will be outstanding assets or liability on the statement of financial position. So these are the things that happen. All right, just a minute. So if the transaction is not settled, then what will happen is that number one, there will be outstanding assets or liability. So like the way the asset was purchased on credit, if it had not been paid within the year, then you will see that a liability will be there, okay, and it will be outstanding, all right, going into the new year. And what you need to go through and understand is the step 2. What you have to do is that you need to be able to determine and distinguish if the assets or the liability that is outstanding is a monetary item. Remember, monetary item and non-monetary item. You need to be able to distinguish between the two. Okay, so you need to be able to distinguish between the two. Remember, we gave examples of monetary asset items to be receivables, payables, and loans. And here we were talking about inventories and also PP, all right? Monetary ones are the ones that you can easily convert to cash, all right? Or there is a right to receive cash and or an obligation to pay cash, all right? Non-monetary is very difficult to convert it to cash. I mean, you need to go and be looking for buyer for your inventory. I mean, it will take time, all right? So that is that. Okay, there is nothing like you have a right to pay or obligation to pay or a right to receive cash. The inventory is seated there, has nothing to do. All right. So if you are able to distinguish between the two, then what you have to do is that if it is monetary, if it's monetary item, then you will have to do what? Retranslate at closing rate. Retranslate at closing rate. We've talked about closing rate. Okay, at closing rate. But if it's non-monetary, what are we going to do? It will remain. It will remain at the historical rate. So we won't touch it if it is non-monetary. Okay. Now, if we go through, if we go through and retranslate any difference, okay, any exchange difference, like what we just did, we'll go through the P&L as exchange gain or exchange loss, just as we just went through. All right. And okay, so for example, what I'm trying to mean is that, let me end this with this. So we might rejoin for a conclusion. So if say on April 1, 2018, you have a company that uses dollar as functional currency. All right. And that company buys goods from an overseas company who uses, let's say, the chromate that we use, all right, as functional currency. So you see the functional currency here is very, very important. And we say that the goods, the price of the goods were, say, at 54,000 chromate. So just as we did. Okay. And payment is still outstanding. All right. Outstanding. Let's say at the reporting date. And let's say the reporting date is, say, 30th June 2018. All right. And we have these exchange rates. So on April 1, just as we did, let's say April 1, 2018, you have 1 is to, or let's say 1.8 is to $1. Then at the reporting date, which is the 30th June 2018, which is, let's say 1.70 is to $1. Then what you are going to do is that when the transaction happens, the date the transaction happens, the initial date the transaction happens, what you are going to do is that initial measurements, all right, or the initial transaction will be what? So you have to go through, and I think we had the same 54 at 1.8, and when we converted it was 30,000, right? So on that date, on April 1, 2018, what we had was that 54,000 will be divided by 1.8, which will give us 30,000. So the initial transaction will be debit purchases, 30,000, and you credit payables, all right, with 30,000. Now, because the transaction is not settled even to the reporting date, what you are going to do is that you are going to, if it is monetary, then what you are going to do is to retranslate at the closing rate. Okay, so fortunately we have the closing rate. Okay, so we will have to retranslate. This is not about payment. Payment hasn't been made. In our initial example, payments were made. This one, payment is not made. Okay, but the standard is saying that if the transaction is not settled, we have to retranslate the monetary items. And remember, an example of monetary item is payable. All right, so it's not the purchases, it's the payable. We need to now retranslate. Okay, so if we are going to retranslate at 30th June 2018, then we need to go through and now divide the 54,000 again. And this time around, it is 1.70. And I think that is giving us 31,765 rounded. Okay, so that is it. So it means that this is the day the thing is. What you are going to do now, is to, and look at this, it's different from the way we did it the other round. We are going to debit, you see, we had 30,000 and we also had our payables. So you see the 30,000 has now become 31,000, meaning that there is an exchange loss. Exchange loss, you can see it's 31,000. Because you are paying it and the amount you are paying has gone up, you are incurring a loss, all right? So it's 765 minus 30,000. So what you are going to get is 1,765. This 1,765 is where we are concerned with, because the money is not being paid. We are just retranslating. Okay, so what we are going to do is to debit our statement of profit or loss with exchange loss. All right, exchange loss of 1,765. And credit, because our value has increased. All right, that's increased. And credit our payable with 1,765. So that at the end of the reporting date, which is this date, you will see that we already have this thing in the system. This one has come to capital. Yeah. As for the inventory that we have in our, because of our purchase, is still going to remain, because inventory is not a monetary item. So the inventory that we did is still going to remain in our books at $30,000, and the corresponding entry, which is purchases, cost of sales, right? This is cost of sales, will still be $30,000. Okay, so these ones will remain because it's non-monetary. Our payable rather has gone up because it is what? Monetary item. All right, so that is it. That is it. You have to rejoin for the last bit of it. I will bring up some questions and you are going to solve it for me. All right. So this is IAS 21, complete and done. All right. Please, any question at this point? Any question?